You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad that you can join us for today's presentation of Option Strategy Selection, what you should think about before you trade. In it, we'll hear from a panel of experts as to what goes into their thought processes when putting on a new position. That being said, ladies and gentlemen, I'd like to introduce you to our moderator today, Mr. Joe Burgoyne. Joe is the Director of Education here at the OIC, and we're lucky to have his knowledge and experience serve as the cornerstone of OIC's educational efforts. And as I know that Joe and our panel of experts are raring to go, let's get right to it. Joe?
Hey, Mark, thanks a lot, and more importantly, thanks to everybody for joining us. Great to have you with us today. We want to piggyback on Dan Graham's presentation last week, this whole idea of, what do you think about before you make an options trade? And we really have a great group with us joining us today. And actually, we're kind of we're getting away from a lot of slides today because the topic really doesn't necessarily lend itself to that, and these guys have so much to offer. We just thought we'll have a few pop-up questions, but more than anything, we're going to have a dialogue here. And I'll start by introducing these guys. They can tell you a little bit about themselves. Al Brinkman, principal at the Brinkman Group. Al, why don't you say hello and tell everybody a little bit about yourself?
Okay, Joe, thank you very much. And again, it's a pleasure to be here and be part of the Options Industry Council webinar series. With it, my background comes from basically an entire options career spent at the Philadelphia Stock Exchange, which is now, of course, part of NASDAQ. I had the opportunity to work on the trading floor, some of that right next to Mr. Burgoyne there, for many years. On the floor, it was a tremendous experience. I started in the early 70s when options just got started, and I've had the opportunity and the privilege, for being on a floor environment, which was a lot of fun and something very different and doesn't really exist anymore, and to watch this industry grow and watch this particular product expand and become mainstream. And it's been a very interesting ride. I always say options have been very, very good to me. And getting into the education part, that came on when I left the trading floor and had the opportunity to join the exchange in the marketing department. And I started doing education in the currency options and index options arena, and of course, equity options. And this is my give back. This is how I feel comfortable. I feel very good about being able to take some of the experiences and the things that I've had and relate them back to investors coming in using options, because I really believe in the product and being part of someone's overall investment strategy.
Thank you, Al.
So
we're lucky to have you today. And, joining Al is Peter Luss, Senior Instructor at SIBO. Peter, how about if you tell our listeners, many of you probably already know you, but please tell us a little bit about yourself.
All right, Joe. Well, thank you very much. And Mark, thank you guys both for having me on today. I started out trading options as a market maker on the floor of the CBOE in January 1993 and segued that into being this instructor kind of guy here at CBOE for the last about 9.5 years. What I really like to tell you, though, is that I am an active trader, which is totally different from what I did on the floor, and it's way more difficult, believe it or not, from what I did on the floor. And with that, yeah, I'm looking forward to sharing some ideas with you this afternoon. And I'd like to say that if you can walk away with one or two things, consider it a home run.
Dynamite, Peter. Thanks for mentioning that. And as always, the price is right with the OIC education funded by the industry. And certainly, last but not least, Mr. Dan Sharton was kind enough to join us today. Dan is president of his own company, Sharton Mentoring. Dan, say hello.
Hello, everybody. And before I get into options, I easily get distracted. I'm an Irishman from Chicago, and I blame Joe on this. He mentioned the price is right, and it's funny. My son and I were sitting down last night, and I have a student that in his off time, he spends most of his time trying to get on shows like Jeopardy and Price is Right, and we watched him for a half hour yesterday on an old Price is Right, and it's unbelievable. Very geeky, but you know what? He gets on, and he did pretty well on the show. I thought it was amazing. I mean, he gets on these kind of shows, but I'm glad to be here. Thank you, Mark and Joe. Glad to be here with the distinguished panel, Al and Peter. Peter, I had the pleasure of standing next to on the floor for quite a few years and getting to know Peter when we were trading together on the floor of the CBOE. But I went down in 1982, and I worked for most of that time with the two bald guys that are on CNBC Fast Money, John and Pete Nigerian. That you guys see on there. I mean that in love. I love those guys, but that's how people would know them, right, Peter? They didn't have a lot of hair, I mean, that's about it. They had everything else, but they didn't have hair. And so I had a pleasure of working with them for many years. It was never felt like I worked a day in my life, but you learn a lot of things from being down there. And I think as a segue into this, as I learned once I got into my own kind of teaching business 15 years ago or whatever, it's just like what Peter said. It's a different ball game. I'm sure Al, Joe, and Peter would all echo this. It's different. It's like we were in the, like assassins in the, it's a horrible analogy, but like assassins in the military, and we come and we work as a security guard at the bank. We just can't nail people, right? So it's a different way of trading, but I think you have a lot of experience you can use in the retail realm. And hopefully today, like Peter said, if you could get a few ideas, and I think that'll be a big help to you. But the key is, try to, don't trade unless you kind of have a plan. And I think that's where a lot of this is headed today. And I'm glad Joe has done put together something like this today, where before you put the trade on, what are some things you should think about? And that's kind of a novel idea. It's like our parents always tell us, think before you act. Well, think before you trade. I can't imagine a better webinar for folk to kind of get some grounding. So thanks. Glad to be here. Look forward to it.
Well, thank you, Dan. And that's why this webinar, it's going to go 3.5, 4 hours, because we have so much to talk about.
I better order a pizza
now. It's about the time your wife gets home from the middle of the state of Pennsylvania.
Yeah, so little bit of housekeeping. I think for those of you who are new to the industry, you know that the industry puts out a document, Characteristics and Risks of Standardized Options. Be sure to get a copy of that. It's actually a very useful document that talks about the benefits and risks of listed options. You can get that either from the OCC or your broker. Again, those of you who are new may not know that the OIC is the educational arm of the listed options industry. Founded in 1992 after the 87 crash, industry leaders decided, heck, we got to get out here and really educate investors, financial advisors, and others, on the benefits of risk of listed options. So that's what we've been doing since 1992. The OCC, as I mentioned, is the clearing corporation responsible for matching each buy and sell order that happens on the 15 exchanges. This is a snapshot of our parent companies, SIBO, NASDAQ, BOX, MIAX, and New York. So 5 parent companies after some industry consolidation. And I think lastly here, this is, for those of you who've heard us before, one of my very favorite slides. It's a snapshot of industry growth. We started in 73 in Chicago with one exchange. Basically at this point we're doing annually over 4 billion contracts a year. A lot of industry growth started in the 1999-2000 time period when we got electronic access to the markets and dual listing, where each of the existing exchanges list all options on all the different underlyings at once. So you got much more competition, tighter markets, and option volume basically exploded for the next 10 years to the point where on average we're doing 16 to 17 million contracts a day, right now. So that's a little bit of background, a little bit of housekeeping. Our topic today, as you know, is what should you think about before you trade, as Dan was emphasizing, before you trade. So I'm going to give each of you an opportunity to speak to this a little bit. Peter, how about if we start with you? What do you like to think about before you trade?
Sounds good, Joe. Joe, if you or Mark were to come up to me and say, hey, Peter, take a look at this stock. That's where we would start. And I'd say, all right, we'll use you, Mark. I'll say, okay, Mark, it's FedEx. I get it, right? It's a $190 stock. Then my eyes would zero down to the at-the-money Federal Express straddle. If Mark is thinking about trading weeklies, I'm looking at the weekly straddle. If he's thinking about trading options that expire in April, we're looking at the April straddle. I want to see what the market is telling me. So I'm looking at implied volatility. And implied volatility is really a great word because the word implied, if those options are pricey, they're implying significant movement in the underlying, maybe. If they're cheap, maybe not so much. So I'm trying to see what the market is giving me with these options and the prices of these options. So implied volatility is very important. And when I talk about the straddle, it's a cheap kind of down and dirty way that Dan and I used to do it in the pits. If I see that the at-the-money call is about $3 and the at-the-money put's about $3, then I'm expecting maybe a $6 movement in that particular underlying between now and expiration. So there you go. That's where my eyes kind of zero into. The other thing, of course, you got to remember, what's at risk? What can you afford to risk? Because too often, traders get on, they got their mouse in their hand or their fingers on the computer. It's so easy to click, right? So you got to remember, take away the green in your eyes sometimes and the money signs in your eyes and think about what's really at risk. And then the other thing, you got to have a forecast. And the toughest part is really what is the stock going to do? That's the first part. That's the most important thing. We got trades for, the stock sitting still or the stock going higher or lower. We got all those trades. We got all those strategies. So what the stock is going to do is the number one thing in your forecast. Number two, you're going to ask yourself, how long is going to take the stock to do what I think it's going to do? And that's time. And number three is something that a lot of traders forget about. What's my expectation of volatility? And we're talking about the Greeks that really make up that three-part forecast. We're talking about delta and gamma for what that stock's going to do. We're talking about time decay, theta, for how long that stock is going to take to do what you think it's going to do. And then we're talking about vega for volatility, which is very, very important. And a lot of traders tend to omit that. So that's what I look at, Joe, when I first take a peek at a trade that I want to possibly make.
Fantastic, Peter. Just so much to think about there. And if I said, this may go 3.5 to 4 hours, I think I'll extend that now to 4.5, 5 with all the topics that you touched on.
Very good. Amen.
Great start. We'll follow up on that. Al Brinkman, what do you like to think about before you make that trade?
Well, I think, Peter's assessment of taking a specific type of stock or a specific recommendation that came from Dan or Joe or the mailman or whatever fits perfectly. I mean, you have to do all those things have to be part of that movement towards strategy selection. Let me take it a little bit on a more broader approach than that, or maybe before we get to that point, approach has how I kind of looked at that question and thought about it is I'm kind of always watching the market. And I'm looking at recent trends in the market. What currently is going on, what's hot, what's not in the marketplace. And I'm not saying that I go with hot stocks or not hot stocks, but I need to have an overview. I need to be looking, I feel like, at a time horizon, not necessarily for putting on a specific trade with that specific stock. That comes in the next phase of this thinking about the trade is what's going on. And in today's world, it's a geopolitical situation. And sometimes what you think is going to happen, or what a lot of the pundits think is going to happen, or looking down the line, is exactly what doesn't happen anymore. We've seen that just recently with the market from that. So, I want to what's going on, and it's not just related to an underlying that I may be considering, like FedEx. And I just throw out there, do they have earnings coming out? Is there a dividend payment? That's part of the process when I get down a little bit more to the nitty gritty. And I'm thinking of the overall, do I want to enter the market? Then the next step is, okay, I see situations here that I think I can deal with, that I'd like to do some trading. Now we move in and say, where's my best opportunity for the trade? And that goes to how Peter described the situation. The other thing that I kind of look at, or I keep in the back of my mind before I trade, is if I put this position on, can I manage it? Meaning, are we going on vacation soon? Kind of thing, and I'm going to be out of the loop and not be able to watch it, or if I am watching it, I'm going to get yelled at from my wife saying, you're on vacation, why are you on that computer? That type of thing. So do I have the time, and does my personal situation allow for effective management? And I don't want to imply, an active management in the sense that I'm watching the trade every minute of every day. Not many of us have that luxury. So, but I do want to step back and say, if I have positions on, am I going to be able to keep a reasonable watch on these to make changes if I have to, whether it be exit the trade, adjust the trade, or however. So with that in mind, that's kind of how I approach it from a more, a broader perspective.
Excellent, Al. Good to have that, broader look. Dan, why don't you talk about your approach before you make a trade?
Sure. And again, I think as Peter and Al have kind of talked about, how I approach a trade now is drastically different than we were, and Joe too, when we were in the pits. And it's a different ball game trading as a retail trader than as a pit warrior, right? You're in the pit trading all day like a crazy man, right? And so as I give a little bit of my thoughts on this, it's more relating with not just how I look at what I think about before I trade, but what I teach. I do this all day as far as what I teach retail traders, what they should think about before they trade. So, more from the retail, hopefully this is applicable. But the first thing is, I tell folk, this isn't like I remember this trader who I worked for in the pits, and he used to come in, and I still remember this. I didn't even, Forever Man. Remember the song Forever Man by Peter? Who was that? Not Led's, Eric Clapton. And he would come in every morning. You say, why do I remember this? Because he would come in every morning at 9:30 or 10 o'clock. This is true. He'd have a couple cans of beer. He'd play Forever Man. He'd get himself all pumped up, and he'd go down in the OEX pit in Chicago. That was the big pit before SPX, and he'd trade them up. And usually every day he'd come up, he'd be down some money. right? And so I used to try to encourage him not to come in, right? And but it's that emotional, like, so in the morning people think that, you have a good breakfast, you do some push-ups, get fired up, and jump in. And no, and I think that's where most people get in trouble. I think what has to steer what I do on a daily basis is something called a plan. And to me, I look at it real simply for most retail traders and myself. Picture 3 buckets, right? And that you'll trade, let's call it your options portfolio. Bucket number 1, and which has been very successful over the last 4 years because the market's just stinking gone up all the time for the most part, would be your retirement type stuff, which is leaning a little bit long, cash secured puts, covered right, put credit spread. Those have been like stinking ATM machines over the last 3-4 years. Why? The market's gone up for the most part. So bucket number 1 would be, okay, I'm going to allocate X amount to these types of strategies where, hey, I like IBM over the next 2 years. Hey, I like Apple over the next 2 years. I'm going to sell a cash secured put. I'm going to do a covered right. I can do a put credit spread. But the point is, it's leaning a little bit along, mirroring in your retirement account. Then you have bucket number 2, which would be, and Peter talked maybe a little bit about that. It might be your you have another little bit of allocation towards speculative, which would be, hey, you know what? Earnings are coming up. I think I'm gonna buy a put debit spread. I think Netflix is gonna back off, or hey, the market has not really gone down 5 or 6% for a while. I'm gonna go out 4 months and buy a put debit spread in May or June in SPX or something. So that's speculative type thing. Now, the third bucket is the bucket that I focus on and I see more students have success with, and this would be called an income bucket, right? The other 2 are income, but this would be more non-directional trades where you're putting probabilities and time decay in your favor. Credit spreads, iron condors, butterflies, calendars, short strangles, whatever, but you win within a range. You're betting on the time decay or probabilities of these trades, and you rely on risk management to make some money every month. That's the goal. And I think that's more comfortable, and I've seen more success with that than students because I think the foundational problem, in my opinion, for 90% of retail traders is their foundation is off. And you say, what do you mean? Their foundation is, what's your opinion? I don't want to know most retail traders' opinion, which way they think the market's going, or which way they think, to pick the direction of the market or a stock on a monthly basis is stinking brutal. I'm not saying nobody can do it. But anyways, so you start with the plan, and then real quick after the plan, all right, I follow this plan. And then I have my different trades, and let's say I'm going to do an SPX butterfly. The way I do it is every month, or a iron kind of every month, and like a four steps. Number 1, how do I set up this iron condor? 2, or whatever the trade is, what is my profit target and max loss? 3, when might I adjust? 4, how might I adjust? So in other words, this isn't just some kind of Las Vegas, let's roll them and let's see what happens. It's, hey, I got a plan, number 1, and then I have these allocation of dollars to these trades, and each trade I have a plan. So there's no emotional willy-nilly when I'm in the trades. I know what's my profit target, what's my max loss, when I'm going to adjust. So I'm not a roller coaster in the trade, right? Market goes down, I panic. Market goes up, I panic. So anyways, I just want to encourage the retail trader, think about this as a business. And then to get good at it, it's a craft. You have to do these, I think, similar trades over and over and over again until you get better at it. So anyways, as my Irish grandmother would say, that's my 2 cents.
Outstanding. I'd say that was at least 2, probably 4.
Yeah,
but,
at least two. I think we're up to 5.5 hours.
Attendees, I got to tell you, that's 10, 15 minutes of 3 different perspectives. Mark will tell us when we're finished how you can go back and hear this thing again through on demand. So, because Peter, Al, and Dan have already touched on a whole lot of things. And Dan, I'm going to come back to you because, again, we're talking about before you trade. You got an empty canvas. How do you go about choosing the underlyings that you maybe want to put an option position on? Do you have certain criteria? And again, I'll start with you, Dan, and then go to Al and Peter.
All right, I'll make it simple. I mean, I've been, teaching retail traders trading maybe for the last 15 years since I left the pit, and I've gone a lot of different directions there. I think you can, but here's my advice to people, right? It starts with the old phrase, jack of all trades, master of none. And I think even in the pit, we didn't trade, Peter, myself, Joe, and Al, I think I speak for them, but tell me if I'm wrong, we didn't trade every stock on the floor of the exchange. We might trade a few stocks, but there were a couple stocks that we knew inside and out, every pulse, every heartbeat, every stinking breath, right? And I don't think trading 40, 50 vehicles and playing loud rock music all day is the answer. But by focusing on the same 2 or 3 or 4 vehicles over and over and over and over and trading similar strategies over, you become a craftsman. No different than, I grew up in an Irish family in Chicago. They were all firemen or electrician or, it's a craft. You do the same thing. So that's my thought on the vehicles. The fewer, the better, and become a master craftsman.
Excellent, Dan. Al, how about you? Particular criteria when you're talking about choosing an underlying?
Well, I think I have to admit, we're all from the same family, if you will, in the options, and I think we're going to find ourselves kind of repeating, if you will, maybe elaborating on some of the stuff. But Dan really hit it. For me personally, and that's what I'm basing this on, is I am following certain stocks. There are ones that I do, or an industry group. If I'm doing an industry group, then I'm going to, at some point say, all right, within this group, what can I do? Now, keeping in mind that we have the indexes, we have the ETF options out there that allow you to get the industry group as a bag full as well. I'm going to be looking for situational things. Earnings coming out, well, let me take a look at this and see what the story is. And this plays to what Dan said. If I look at the earnings and stuff, what I need to do there, one of my things is I'm going to go back and I'm going to know, because I've traded some of these are stocks, usually the ones that I keep in the group are ones I've had success with. So if I don't have all that much success, I'm more than happy to say, okay, that was a bad idea. I won't trade that anymore. But look at these things. I have that group of underlyings. As I said, I maintain an active research on them. And by that, to me, to a grade on my side, I'm getting a little ahead of this, but it's technical analysis, the charting piece. I grew up with that. I've used that. I've found it. I feel comfortable with it on that. If, however, something piques my interest, if there's news event or some of the research that I'm doing peripherally piques my interest, then I'm going to add that chart to the group and start to follow that. Overriding all of this with these underlyings that I'm saying are in the bag, if you will, that I look at, or the group that I look at, is liquidity. And Dan hit it right on the nose. I need to have liquidity in the option and in the underlying, particularly in the underlying, because it's determinant of our bid-offer spreads in the options. That makes the option strategies a lot more, it moves the probability, I guess, of success kind of in my direction. When I know I have a narrow bid-offer spread that I'm working with, I can get in and get out, particularly on the get-out side, whether it's a good get-out or a bad get-out, I need to get out. So any of the stocks that get into this group, as Dan said, this group that I'm staying with and I'm getting comfortable, and I know, when the chairman of the board got up in the morning and what he had for breakfast type thing. But seriously, I need to have, it's not getting in this group unless it has the adequate liquidity and trades, and the bid offer spreads stay within reason, and I can keep an eye on that. I'll look at volatility levels, historical and current, see where they are, see where the pricing is, that type of thing. I'll bring that into the analysis. Before we make that final decision, this is what I think about before I say we're going to trade. Then that takes us on to the next part of the webinar. But I will mess around with the option pricing calculator. Again, I'll take it today and say, all right, this is interesting. What if I did this? What would be my expectations and type thing? So I'll run some war games, if you will, coming from my military background. I'll war game scenarios before it, and I think that's important. I think just really quick, and I'll pass it on to Peter. But I think it's important. One thing about the steps to making these decisions is you need to study. You can't. Options require what I like to call stubby pencil work. You need to work at these. You need to spend the time looking at the scenarios, looking at the strategies, and getting comfortable with how they work and what could happen, best case, worst case scenarios, all that. I think paper trading is a great way to go. As I mentioned, I war game stuff all the time. I'll war game a strategy, I'll war game it and stuff like this to see what are my probabilities of success if these situations occur. That type of thing. And let the theory and the actual work out. And then at some point in time, you do have to pull the trigger. You got to go live and get in the game. And sometimes you learn by the school of hard knocks. I think all of us on this webinar today can probably raise our hands and say, yes, I have a few of those that has happened, but you got to keep coming back. And, Dan talked about the plan. And one adjunct that I found very successful personally was I keep a log of my trades. And I try to keep it as honest as I can because just like the coach, after a while, I see tendencies appear. And they could be good tendencies or bad tendencies, who knows? But the point of the matter is I keep a log, and that really helps me focus in on my personal approach to this. Do I need to tweak this? This has worked before, that type of thing. So with that, Peter.
All right. Thank you, Al, very much. Mm-hmm. Well, here you go. The question is, how do you choose these underlyings, right? And I'll echo a little bit what Dan said. I've known Dan since, early 1993, and we did have a pit with 20 stocks in it, and that was plenty to follow. And, you look at Kramer on TV, and he's looking at 3,200 stocks or how many there are, but he's got an army of kids that help him with that, 20, 25 stocks is plenty. I could take a screenshot right now of my trading platform, and that's what you're going to see is about 22 stocks. And just this year, it's a short year so far, but I've only traded options on 3 underlyings. And then the fourth, I guess, would be SPX. So we keep it pretty brief. They're like your kids. They all behave differently. I'm glad I got 4 kids and not 22, but that's kind of the way it goes with that. Now, if you're looking to expand that pit a little bit or create your own virtual pit, what I like to do is attack stocks that interest me. So if you're interested in these stocks as to what they do, it certainly has to give you a little bit of a leg up as opposed to me following some tech stock that I have no clue on because I'm so aged at this point, right? So that's my answer to it, is try to trade things that interest you and trade a small basket of them as well. Thanks, Joe.
Excellent, Peter. Thank you. We want to go to a quick pop-up question for everybody. Do you use stock charts? If you would just respond either yes or no to that. Dun, 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 dun. All right. So let's see. How we doing? There we are. Okay.
Whoa.
Well, there you are, fellas. That almost 92% use stock charts and about 8% don't. So there's a little feedback into our audience. So let me back up a little bit. Now I'm going to come to you. We kind of, Dan talked about, he's not so interested in a retail investor's opinion on the underlying, but when we put on option positions, oftentimes that's what we need, an opinion of the underlying. So if you would offer, maybe your insights out as to, you touched on a little bit already, but how you come up with a forecast for that underlying. It's technical analysis. Anything else you want to talk about on that?
Well, with 91% of the people using the charts, and I think those of you that listened to Dan's excellent webinar last week using points with the Japanese candlesticks, which I admit I don't use as much as I use more point and figure. That goes back a long time. be that as it may, it does the same basic thing, and it's got the same type of thing. And I really do use the chart to look at that trend and get a feel for it. I will be doing some historical research on it, if it's a situational type trade. In other words, if it's a trade where I'm looking where earnings are due out in a period of time, what I mean by, historic research, I'm going to go back and I'm going to spend a little time looking and say, okay, what happened last time? What were the predictions on earnings? What were all the talking heads saying for it? And what happened when they came out? Were they on target, off target? And then how did the security react? Knowing full well that the standard, disclaimer is past doesn't mean what's going to happen in the future, but it gives you an idea that the stock does react or doesn't to an earnings announcement, up or down, because once again, that little bit of information in there now starts to steer me towards perhaps a group of strategies or a specific strategy to take care of that, to make a trade based on that type of information. So it's, the forecast, however you look at it, whether you're looking at a chart pattern with a breakout with a potential on the upside or downside for significant movement, then trying to determine what amount that will be. And Peter certainly touched on this at the very, very beginning of the element. And one of the elements is, if I'm looking at this and I come up with a 10% move from the current price levels over a period of time, and the time is another critical element in the options world, we know on that, it's certainly going to push me to a different group of strategies that I'm going to start to distill down to see which one of these I want to use, given the other factors we have to do in on the strategy, the volatility, the underlying, the time, and that sort of thing, that we're looking at that. And then if that 10% is actually 25%, and our time is, hey, it's going to be up 10% in the next 40 days, as opposed to up 25%, I'm going to be looking at a different group of strategies and a different way to put this on, and that type of thing. And you know what? That movement piece also, and the time piece of that, allows me to put a key element of what I call the risk management plan. And Dan hit on that. I think all of us agree to it. You have to have the plan. You have to have the plan, and you have to stay with it, which is part of it. But in other words, let's take my forecast. I come up with a forecast that says, I think the stock will be up 10% in about 45 days. I've kind of set my parameters of what type of strategies I'm going to look at. But I put a trade on, and 30 days later, I find that we're only up 3%. Now what do we do? Now what my forecast didn't work, what do I need to do for the option position? And we're not going to touch on that right now. We will as we get into strategies, I'm sure. But
we will indeed.
For me personally, I'm looking at trends coming in and situations occurring through chart patterns as my primary. Doesn't mean that I don't include fundamentals in it with earnings reports and that sort of thing, and fundamentals with the company moving forward. But my overarching, for me personally, is the technical analysis.
Dynamite Al. And Peter, I know when we started out, you talked about forecast being kind of number one. What's the stock going to do? How long is it going to take? What's the expectation for volatility? Any recipe as to how you decide what the stock's going to do, how long it's going to take, and your expectation for volatility? Any insights there?
Well, first of all, I got to tell you, I'll look at a price chart, and I'll look at historical volatility chart on livevol.com. That's about it. I mean, Head and Shoulders to me is just a shampoo, and I don't mean to be silly, but that's just kind of it. I don't really buy any credence into that, and maybe that's because that's the way I was trained. I was kind of thrown in the pits, as they say. That's how it was. I mean, I had a month worth of training that was not really training. It was just standing next to a trader observing. So I really learned from more of the gut feel than anything else. So I really don't rely or look at charts much at all. I had to give a presentation on charting one time, and this is pretty much how I started out. I said, if you like it, good for you. Anything that helps you in this business is certainly a blessing. So now to answer your question, Joe, is that I just follow that same group of stocks and try to track that behavior. And I'm a big proponent of, I just love to trade earnings periods. And I just know what the stocks have done the last 3 periods. And it just helps me determine, history doesn't always repeat itself, but it's a pretty good key as to what's going to happen. For Alta, for instance, I know I'm going to get some significant movement in Alta every time, and I trade it every time for earnings. GoPro was a great stock until it cratered, below $6. Again, it just comes down to following that selected number of stocks and watching them closely. And that's it. There's no magic formula that I can offer anybody on that. Just a small little virtual pit that I've created for myself.
Fantastic. Dan, how about you? I know you're not so much a forecast guy, but any perspective?
I mean, if Fibonacci wants to come over to the house or Gubernacci wants to come over for a little Italian pasta, I'm up for that, Joe. You know what I'm saying? I'm very friendly with the Fibonaccis and the Gubernaccis, and I joke on that a little bit. I think again, let me just say this: technical analysis is a great tool, right? And I think like Al spending time on it, it's a great tool, and it can be a helpmate, like anything can. But I think, I'm more of the school with Peter where, when you're, and it's kind of the same thing. I don't want to say it's not, it's almost technical analysis by feel, where in other words, if Peter or I are watching the same 4 or 5 vehicles 8 hours a day for 4 years, you're living them, you're breathing them. Their blood is your blood. It's like a mother being around a baby all day. After about our 4th kid, we stopped. I'm not saying we stopped going to the doctor, but when the teething and the fever started with the kids, my wife's like, I'm not spending the money. They know, right? The mothers know the kids for the most part. And I think the technical analysis is a great tool. I think some retail traders use it the wrong way as like a Charlie Brown security blanket. Or was that Charlie Brown or Linus with the blanket? Who was that with the blanket? Was that whoever it was with the blanket? Linus was with the blanket. But I think a lot of retail traders feel good, right? They have a little hot mocha and they make their charts and it's going up and they feel good about it, and then it ends up going down. Now, I think, again, with all that being said, I think where would I use charts? And again, I look at charts, but I'm just looking, it's like Peter seeing, you kind of know where they've gone, right? I mean, if you're looking at a stock, okay, I like them long term. You know what? Maybe every month I'll sell a cash secured put or I'll do a covered right. It's a little bit bullish, but I'm taking a longer term view. So obviously I have to look at the chart and say, hey, I like this over the next year. Or in the speculative part of a portfolio, I play a lot of earning stuff too, like Peter. But if I have an opinion, hey, you know what, SPX is up. I think the best spec opportunities you'll ever find are in the same stocks you're trading for income. So we trade SPX and I trade Tesla for monthly income, and we trade Apple and we trade RUT. Well, those are the best spec trades. You say, why? Because those are the vehicles you're watching all the time. So like right now, when SPX goes near 2,400, when it's any time it gets near that level, I'm like, hey, you know what? Maybe I want to buy an out of the money put spread, or maybe I want to sell a call credit spread, or we're in the upper end of the range. I'm familiar with it, right? So I think that stock charts and the technical analysis come more in the buckets of long-term, like retirement, income, and spec. But in the nuts and bolts, what we do is, butterflies, calendars, iron condors, that type of stuff, we slap that stuff on every month until you die, and you manage the risk on it. And that's it. We may tweak it based on the volatilities and the price levels, but it's methodical over and over and over, and we'll diversify the risk in different ways. But I think that's important. But all I'm saying is this, and I challenge my students. Let me just say one last thing. I challenge students. Most students spend a lot of time, and this is very normal. 91% use stock charts. It's probably the same in my community too. But every new year, when I give my New Year's kind of talk to the students, I'll say, look, if you can spend, here's my, how do you become a great option trader? If you can spend 1/3 of the time in 2017, 1/3 of the time that you look at, CNBC, and you look at charts, and you look at blogs, and you read all this material, if you take 1/3 of that time and spend it on working on the craft, understanding the strategies, knowing your vehicles, sticking with a few strategies, understanding the risk, the craft, you're going to be a phenomenal trader. But I think that it's so lopsided. I think people spend way too much time, less time on the craft. You know, when we were in the pit, and I'll speak for all four of them because it's got to be similar. Al, Joe, myself, and Peter, we spent a lot. I'm not saying we didn't. Al might have spent more time on the charts, but we spent most of the time in the pit ripping apart our position. How did it look? What if the vols went up? What if the vols went down? What if the stock went up? What if the stock went down? What are earnings? We're working on our position. Do we want to be short these options? Do we want to be long these options? And I think the retail trader, way too much time on the stock charts. They need to spend more time on the craft if they want to be successful. So I didn't mean to yell at any of you retail traders. I think the focus needs to shift.
Outstanding, Dan. Let me go back to the audience. Let us find out a little bit about you. How many different option strategies do you use? Could you take a second and just answer here? You don't use options, 1 to 2, 3 to 5, or more than 5. Let's find out. What are your tendencies? You got the feedback from our panel, and as I said earlier, you can check this out on demand because there is a wealth of information coming down the pipe here. Okay, so interesting, guys. I mean, the focus has been on a small universe of underlyings to trade, and that's certainly where this community that's joining us today is. So thanks for that. That's good.
Yeah, I just interject with what Dan was talking about is to me, I'm looking at this with people using 1 or 2, 3 to 5. There's an indication to me inside of this that there is that craft approach. That folks are using these strategies because they are comfortable with them. They do have the mechanics and the of that strategy down, and they know how to overlay it to forecast positions. They may not use it with a specific forecast, not knowing which of the strategies, of course. But the point is, I think you're seeing there that in kind of not defense of the charting type thing, but just on the side, people use those, and maybe they you use them as that that indicator. But it looks to me from this that people are working on the craft, as Dan said, saying I want to be good at these strategies. And I think probably as we move through the seminar, that topic is going to come up somewhere along the line. I have it in my notes. Be comfortable. Be good with the strategies that you use. So I think there's an indication there that our audience in general is working hard to improve the craft side of this as well.
Let's get a sense for the mindset when it comes to putting on a position. What affects your thought process more? How much money you make, or how much money you could lose? What do you focus on? How much you can make, or how much you might lose? This gets back to the whole idea of that all-important aspect of risk management. All right. Any comments on that before we go to our scenarios?
Sure.
Yeah, go for it.
All right.
Oh, okay. Yeah. So I think it's got to. Again, I'm not trained in the yin and the yang, but I think there's got to be a balance. Like you have here, 61% say they're focused on how much they can lose, 38% how much I could make. My answer is, if you say what affects your thought process the more when putting on a new position, I think it's got to be the yin and the yang. It's the plan. In other words, if I put for example, let's say I put a $1,000, just using this for an example, $1,000 calendar trade on. Okay, it's $1,000. A calendar, it's usually a debit transaction. And so let's say I buy a calendar in the SPX and I pay $10 for the calendar. And it's $1,000. And that's not far off what maybe a 30-day calendar is in the SPX. So I pay $1,000. Okay? So when I do that as part of a 4-step process, I say, okay, what's my plan? What am I trying to make? And I may say, okay, typically on a calendar I might try to make 10%. In a month. Doesn't mean I always make it, but you got to have a plan, right? What's your plan? And I think the key here, folks, is how much you make and how much you can lose. They have to go together or you're going to get goosed. In other words, how much money I can make. It's a $1,000 trade. I'm trying to make 10%, $100 bucks. Okay? So let's say I just focus on that. I want to make 10%, $100 bucks, but if it goes against me, I leave it alone and I lose it 500. That ain't going to work, right? That's not going to work, right? And the other way is, so what I do is I say, okay, if I'm looking to make 10%, I don't want to lose much more than 10, maybe 12, 13%. If I'm trying to make 20%, I don't want to lose much more than 20. If I'm trying to make 5%, I don't want to lose much more than 5. In other words, because if you're doing these repeatable trades every month, and I'm doing this $1,000 trade every month, and when I usually win, I make 10% of 1,000, that's 100 bucks, and when I lose 500. It ain't gonna, excuse the bad English, it ain't gonna add up at the end of the year. But if I make it 100, make it 100 in January, make 100 in Feb, make 100 in March, make 100 in April, and then in May I lose 100, I'm not quitting the business, right? So you have to keep your losses not that far from your winners to keep this thing going. So I think the bottom line is they got to go together. It's got to be a yin and the yang or whatever that is, but somehow they got to work together. Anyways, that's my...
Dan, I'm going to follow up with you because we got about 10 minutes left, and I do want to cover a bullish, bearish, and neutral strategy. And, you're talking, essentially cutting losses when appropriate. You want to go through a specific example, and the time spreads can be a neutral strategy. You're talking dollars and cents. You want to just run through quickly a neutral strategy and how you'd approach that. Either letting your profits run, cutting your losses if you're wrong. Want to run through a neutral one?
Yeah, should I just stay with that calendar theme, Joe?
Yeah, go for it.
Yeah, so you mean just kind of talk one. So let's say, for example, folks, if we're looking at SPX today, and I'll just give you kind of, again, staying with that kind of four-step risk management. So let's say I'm doing generally I would do at-the-money type calendars, and I like short-term expiration stuff, but I also like a mix of shorter duration and farther out duration. But let's just say I'm looking at today is what, Wednesday? And typically we do Wednesday. So a lot of times we do a 9-day, we've been doing this for years in our community, a 9-day calendar. All right, so let's walk through kind of the process of a 9-day calendar. So step one, the setup. How would I set up? I'm doing a 9-day calendar. So again, the idea is I'm going to do a calendar every Wednesday for the whole year. I'm committed. I'm in. Whether I make money a little bit or lose money, my toe hurts, my stomach hurts, Jim Cramer says something, or the Cubs lose, I don't care. I'm committed. I'm doing a 9-day calendar. So every Wednesday, and so if I did one today, I'm going to sell the March 31 expiration, which is 9 days away, right? March 31, which is be a week from today. And so I'm going to come in every Wednesday in the morning. I'll sell the 9-day, and then I'm going to buy my long about 14 days away. So in this case, it may be buying like the April 13 or the April 21 expiration against it. So I'm going to have a couple weeks between my short and my long, and I'm going to do it at the money. So I'm going to come in an hour after the market opens, and I'm going to do that calendar every Wednesday at about 9:30 for the next 50 weeks, right? And so step one is the setup. How am I going to set it up? I'm going to do the 9-day calendar every Wednesday. Step two is, what's my profit target and max loss? And let's assume, which it is, maybe about a $1,000 trade. The overall thing, if I'm going to do it 52 weeks, is, hey, I'm going to put it on Wednesday. Probably 50% of the time I'm out by Friday, 80% of the time I'm out by Monday. And so step one is the setup, how I set it up. Step two in the 4-step risk management process is I'd like to make 10% profit. So if it's a $1,000 trade, I'm looking to make $100. And if it goes against me, once I'm down, let's say maybe 12%. So I'm looking to make 100, but if I'm down 120, game's over. I'm at the casino. I went, my $1,000 was all I was going, was the most me and my wife were going to spend. We're down 1,000. We're done. We're going to go out for dinner, right? So step two is my profit target and max loss, and that rules it. Step three might be, hey, within those confines of my profit target and max loss, on the way to my max loss, maybe if I'm a third of the way to the max loss or half to the max loss and I want to fix it a little bit, right? We would call it an adjustment. If it's going against me, let's say to the downside, I could buy a put. I could add, if I had 2 calendars on, I could take one off and move it, turn it into a double calendar. There's different things I can do. That's called the adjustment. That would be the adjustment, when I adjust and how I adjust. But the point is this: I have a plan. The plan is I'm putting on a income trade, and a calendar is an income trade because your short options are going to decay a lot quicker than your long options, and you're going at the money. But the bottom line is it's all set. I've got the structure. When am I going to do it? Every week, every Wednesday. How am I going to do it? At the money. What's my profit target and max loss? Boom. When am I going to adjust? How am I going to adjust? And I think once you do that, you start building this thing called a craft. And once you do 20 calendars in a row, that's where the magic happens, right? But you got to get through 20 calendars. And the problem I've seen, Joe, is 90% of retail traders, they're like a merry-go-round. They're like the hamsters in that thing that go round and round. This week they do this. Next week they see a webinar. This guy trades on spiked heels and a football helmet, and he does something. The next week they're doing a butterfly with a Brooks Brothers suit on, and the next week they're doing this. And you know what? They're jack of all trades, master of none. And the way to get good at this is craft over and over and over till the cows come home. So anyways,
got it. Excellent, Dan. Hey Al, how about a bullish strategy and the approach you take? Go for it.
In a minute and a half, right? We can do that, okay? We're talking about a bullish forecast. We're forecasting an up movement in our underlying. Now what we have to look at is there's a whole bunch of bullish option strategies out there. The trick here is to fit the forecast into the best possible strategy for those, and a little bit simplistic, I suppose, I'm looking at. So let's just assume, sorry about this one, Dan, but let's just assume we've been following the pattern on good old XYZ, and it's showing a steady.
Thanks, Al.
We see a steady uptrend. Now I've been following XYZ for about 18 years now, so but anyway, we see this uptrend and say, you know what, this stock does that. It tends to continue on an uptrend until it doesn't. And I think we also have to. The approach is we have to look at some basic fundamentals. Earnings. Okay, in this case, let's assume that earnings are out. They're out of the way. They're not coming up for a period of time after that, and we can't foresee any volatility events looming on the horizon. There's no drug approval thing out there. They're just moseying along, and we're hoping none of the board of directors go to jail on this to do it. So we take our forecast, overlaying the chart, doing the Ouija board, whatever we need to do, and we're going to say, we think we're comfortable with a 10% move over the next couple of weeks. Again, I'm just trying to put together, a sequence of events. Now we need to stop and go back to what Peter said at the very beginning. We got to overlay some of those option Greeks to determine how they factor in for what's the risk that's going to show up in this. Volatility, past, present, and future. We see the current vol levels are in the mid-range, or based on historic, not showing to be excessively high or low. They're just kind of moseying along there. So, again, volatility becomes a concern that if we're just long this, we're exposed to it falling, and we don't have a hedge against it. And conversely, if we come in short vol, and we're exposed to it rising, and we don't have a hedge against that move. So what are we going to need to do? Well, and we step back and say, what's another one of these? There are Greeks we got to look at. Time decay, theta. All right. It's not everything involved, but it is certainly a thing involved in our strategy. So I said at the outset, we're looking at spanning a couple of weeks to put this trade on. We're not doing the Wednesday thing. We're gonna go in this for the really long term. We're going for maybe a couple of weeks here. So we're looking at these factors: a 10% bullish move in the time period for a few weeks. And theta's a little bit of concern. Well, we need to figure out what we can do. In this case, I would say I would be looking at a debit call spread. Long strike that would be slightly in the money, and a short strike at the top end of our pricing. Our 10%, if you will, our 10% move. This looks like when we start it out, it might give us the best opportunity. We've neutralized the vol impact and as well theta, long, short, that type scenario. We retained a little delta from the long in the money versus the short out of the money. Okay, we're net on a positive. So it enables to spread the profit. We've got the hedge on, as I said, and because we have the long short position, we've done a little neutralization in that. And, you know, that's kind of it. That's just kind of a putting these Greeks in across the board. And we talked about volatility in Vega. Peter did at the beginning. This is another one of those things that's part of the craft, as Dan said. This becomes second nature to you. It's a natural. We do it. We integrate this. We have got to do these and look at these because they're measurements of the options risk, and they give you some insight into the trade's exposure to these various pricing factors. What kind of exposure does it have a change in Vega, in volatility? What exposure does it have to time decay? That type of thing. So anyway,
vertical call bull spread. It works. It works, Al.
Yeah. That said, I would also say that take that stubby pencil out, and maybe you want to take it a couple other bullish strategies and just to see, to be sure, how it fits over things. But anyway, there you go.
Excellent. And Peter, to wrap it up,
I rest my case.
You got it. You're minute and a half.
Joe. Now that now that they're knocking on your door, here's the deal. I'll just throw a quick trading idea out there for you, and we can shut the whole thing down today. Here it is. You know, again, what is the market giving me? How about this for a trading idea? How about trading a bear call spread just outside of one standard deviation or the expected move of perhaps even just the straddle, you know, which is said to be 80% of the standard deviation, but we don't care. We're not mathematicians, right? Trading is an art, not a science. So the point here I'm making, just maybe possibly trade a bear call spread outside of the expected range of the underlying. How about it? You're going to sell a call and buy another call for insurance up on top. Maybe we can talk about it tomorrow night in New York if you're out there. Maybe two of you that live out there perhaps that are listening today, who knows. Or we can even revisit this again with Joe on another webcast. But thanks, Joe, and I'll pass it back to you.
Peter, thanks so much. And everybody, I'm going to turn it back to Mark. Before I do, Al, Peter, and Dan, thank you so much. We could have gone 3.5, 4 hours, and maybe one day we will. But, Mark, I'll turn it back to you.
Well, Joe, thank you. And Peter and Dan and Al, I want to thank you as well. Great information. The questions and comments that were coming across, while plentiful, and I certainly apologize that we weren't able to address any of them specifically. The comments were really fantastic, and everybody certainly appreciated all the information that you gave to us. We do apologize that we've run a little bit long, so let's go ahead and just remind everybody to follow us on Twitter, like us on Facebook. Again, thank you for attending, and we look forward to seeing you next time. Good night.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.